Welcome back. The Telecommunications Regulatory Authority, also known as the TRA, said on Monday that the UAE's local market cannot handle a third operator, ruling out further liberalization of the telco sector, which is controlled by two majority state-owned telecom firms, Du, based here in Dubai, and Etisalat, based in Abu Dhabi. To discuss what those comments mean for the two operators, we are now joined by Irfan Ellam, telecom analyst at Alma Capital. Welcome to the show. Good to have you here. Tell us, we just heard the news that the market will be dominated by two big players. Does that come as a disappointment for consumers who were hoping for more competition, better prices, better service?
I think initially it probably does come as a disappointment for consumers. But if you look slightly deeper, what we've seen is since Du has come into the market, prices have fallen. We've now got 200% penetration roughly in the UAE in terms of mobile, and there's not much more room for growth in terms of penetration. What this means is that both companies will have to become more consumer friendly and give the customers what they want, and prices will continue to come down further. So it's actually not bad news. Given the level of penetration, we will see prices coming down further.
We saw quite a positive share price reaction yesterday with Du, but not Etisalat, which is listed in Abu Dhabi. Why is that?
The two companies are different in the sense that Du just operates in the UAE, whereas Etisalat is actually a multinational operating in so many other countries. So the news will actually be more beneficial for Du. Etisalat, by way of being the former incumbent, has more subscribers who spend more money, and these subscribers may potentially move to Du if there's mobile number portability being introduced.
Etisalat nearly has a monopoly when it comes to broadband internet and to television cable networks. Now, Du is sort of getting into that market a little bit. Now we heard that the two companies want to cooperate. Each wants to gain access to the other's network. How is that progressing, and will there be advantages for consumers?
There will be advantages for consumers. In terms of progress, it has been delayed. It was meant to come in last year. It's now scheduled to come in this year. No firm date has been given yet.
Why the delay?
We haven't been told. It's testing of equipment and the negotiations that the two companies have been having. In terms of will it benefit the consumer? Definitely. Du, which just operates in New Dubai, will have access to the entire country, and broadband as a whole will become more and more mainstream. There are roughly 600,000 internet subscribers in the UAE. Half of those still use dial-up, so there's a lot of growth to come from the broadband market.
Let's talk Etisalat again. The company is on a very aggressive growth path at the moment. It wants to buy a 51% stake in Kuwait operator Zain. It is not only looking at Kuwait, it's also looking at Nigeria, India, Syria, etc. Does that scare analysts, investors off at the pace is so fast?
I think, you look at each country and take its own merits. Overall, if we look at the company Etisalat, questions are, can it afford it? And the answer to that is yes, it can. And the second question is, can it manage these operations, and does it pay the right price for them? On the whole, it's a good manager of assets, so it can manage the operations. In terms of value, sometimes they may have paid a little too much, and at other times they've got very good deals. They have a stake in Mobile in Saudi, and that has performed very, very strongly. Their operations in Nigeria are performing strongly, and the operations in Egypt are doing well as well.
But it's $12 billion we're talking about. Isn't that a really large number? I mean, that's just the stake in saying it.
It is a large number, but Etisalat is going to become one of the largest telecom companies in the world through this acquisition. So it really is, a sort of well-sized company, if you like, in terms of market cap. And this gives it a very, very good footprint. With its existing footprint and the Zain footprint, I would say it has the best footprint in the Middle East and North Africa.
Now, what do you think? What is the probability of Etisalat failing to buy a stake in Zain, and what would that mean for the share price?
I think the offer they've made for Zain, it's a generous offer. From that perspective, from a pricing perspective, I don't see there being a problem. I think Zain shareholders will accept the offer. In terms of what comes out of their due diligence, which they're undergoing at the moment, press reports are saying it's positive. So I'd say the probability of the transaction failing is actually very low. I'd say it's probably 80-85% that it will actually succeed.
When will that due diligence process end? What do you think?
Rumours are that, or press reports are that it will actually end by the end of January. So we're talking a couple of days. It may get extended a little bit.
So we don't need to worry, really?
We don't need to worry, no, I don't think so. If the deal wasn't to go through, I think the implications are more for Zain than for Etisalat. I think we could see weakness in Zain's share price, which has been boosted by the merger talks.
Okay, so it's nearly 100% sure this deal will go through?
I'd say probably 80-85%.
Okay, good. Thank you for coming today. Great to have you on the show. Well, that's it from the business desk. You can contact us at news@cd7tv.com. Up next, Laura Buckwell is back with the news.